Is quantitative tightening actually inflationary? This is a question that has come up a few times recently, given the shenanigans that the Federal Reserve pulls on things like the reverse repo facility, their balance sheet, interest rates, and it gets quite complicated. And so we are going to dive into the weeds today to answer the question once and for all, whether quantitative tightening is inflationary when the Federal Reserve thinks, or at least professes to think, that what they're doing is combating inflation. By the way, if you haven't heard, right now my courses are on sale, so if you would like to know how to invest during bear markets, that means identifying the best companies in the world. Then number two, figuring out what price you should be paying for those companies, making sure you're buying them on sale. Get my bear market investing guide, $99 only, right now in the description below. Now, this is where I have to give a quick shout out to you guys. I really appreciate you always asking me questions, providing comments, your thoughts, your feedback, your criticism if I got something wrong, because honestly, it gives me ideas of things to make videos about, and it helps me know where I need to study up and learn things so I can present it to people, because if you guys are talking about something, that means that most people are probably wondering about it as well. So shout out to Robert on Twitter. You tagged me in this tweet. It was a screenshot of a report from Luke Gromen, which is prompting this video right now. So Luke points out that the Fed could easily have to pay $200 billion a year to banks next year, and it could get even higher than that if the Fed funds rate does get above 5%. Depending on how high the Fed funds rate goes, the Fed could have to pay $300 billion per year to banks. Now, I have to say I have a ton of respect for Luke. He's brilliant, and I'm not disagreeing with him here. I just think there's a little bit more to the story on whether it's inflationary or not. Let me show you why. If you follow the path he lays out, they print $200 to $300 billion, they pay it to the banks. That means the banks are keeping the money with the Fed instead of lending it out other places. Except for the fact that the banks do lend it out to other places, they just use it to buy US Treasuries and mortgage-backed securities. He says this is $200 to $300 billion per year in QE via US banks, with the US CPI still elevated. So while the Fed shifts to a loss, that is effectively a pivot. If this is indeed true, that means the more the Fed hikes the rates, the more money it will inject into the banking system, which is just like QE, because banks use that money to buy treasuries. His conclusion is that most roads now appear to lead to inflation, because if the Fed stops hiking rates, well, that's inflationary. But if the Fed continues to raise rates faster, well, that's also inflationary. If the Fed cuts the rates on the reverse repo facility, then that is also inflationary. So let's break these conclusions down here, because the path that he laid out is technically correct. As rates get higher, banks keep the money with the Fed and they get paid to keep it there. This is opposed to when rates were really low and the Federal Reserve was doing QE. The Federal Reserve was printing money and they were buying US Treasuries. Not directly from the federal government, but essentially that's what happens. And so the federal government then can borrow money from the Fed that's printed into existence and spend it. That means that the federal government basically gets to spend new dollars into existence. So at that point, federal government spending is inflationary. And that's what's happening when you look at their balance sheet. Every time their balance sheet is moving up, the Federal Reserve is printing money and they're buying assets. So if the Federal Reserve creates money out of thin air, then goes and gives it to somebody like a bank, and in return they get an asset like a treasury, that means new money is now in circulation that usually just goes to that person and that bank, and then they go and buy another treasury and sell it to the Fed, and they keep on doing that over and over again. That means there's more cash being injected into circulation. When you get something like a few trillion all at once, then you get multi-decade high inflation, because you have more money chasing the same amount of goods and services. What we have right now is quantitative tightening. That means that they are selling assets off their balance sheet, or at least not letting them roll over. And so when that debt matures, that's dollars getting paid back to the Fed, because that's debt owed to the Fed. That's what that asset is. It's debt. And what the Fed does with that is nothing. It ceases to be in circulation at that point. And so as the Fed's balance sheet comes down, this is a force that puts downward pressure on the amount of money in circulation. The other thing the Fed is doing is raising interest rates, and this is what Luke talks about, that as they raise interest rates, this means that debt becomes more expensive. As debt gets more expensive, what do people have to do? They have to pay that debt off, or at least more of their income is devoted to paying that debt. And so debt costs going up is a deflationary force. All else being equal, that pushes downward pressure on the amount of money in circulation because more money has to get sucked out to go pay that debt, either the debt service costs because they got more expensive, or paying off the debt to deleverage because you can't afford the debt service cost. Okay, so on the surface, quantitative tightening and raising interest rates are both deflationary pressures, simply because they suck money out of circulation versus QE and lowering rates put money into circulation. But what about the reverse repo facility? There's over $2 trillion that the banks keep with the Fed through the reverse repo facility, and they're getting paid like 3.8% on it right now, risk-free. My other question would be, what about US Treasuries? Because a 2-year Treasury right now is paying 4.4%. What this does when you have central entities who are considered risk-free because they are governments and ultimately they hold the monopoly on something like taxation or money printing or violence, basically you get money getting sucked away from the economy and allocated to these non-productive areas, like the Fed's reverse repo facility or the United States Treasuries. Let's do a thought experiment here. What do you think would happen if Treasury rates hit 20% tomorrow? 2-year through 30-year, they were all 20%. How many people would sell stocks, would sell their corporate debt, would sell something, and they'd go put it in a 30-year Treasury paying 20%? Most people would do that. That would be a smart financial move. What this also means is that as interest rates go up, entities like the Fed and the Treasury, they absorb money that's no longer being allocated to the free market. That's capital that's no longer available for business, for spending, for consumers, for hiring, for pay raises. It's getting sucked out of the productive economy and going and sitting over there with a non-productive government entity. That is a deflationary force. And so Fed raising interest rates faster being inflationary, I don't see that. While it does mean that banks are getting paid by the Fed and they can use those to turn around and buy collateral like treasuries and they can buy things like mortgage-backed securities, we have to see how this translates to the actual cause of inflation, which is the money supply, not bank reserves, because if bank reserves caused inflation, then we would have had inflation in 2008, 2009, 2010, and we didn't. We had an increase beyond what the baseline would have been in bank reserves, but not a meaningfully large impact to the broad money supply. And when we look at M2, which is the accepted measure of the money supply, we zoom in on what's been happening all year, and the money supply has been slightly moving down. We're sitting at 21.3 trillion, which is the exact place we were at the end of November in 2021. We moved up a little bit and then have moved our way down, and so we are sitting flat for over a year now. During this time, the Fed has been raising rates. They've been paying more to banks on their bank reserves. They've been paying more in the reverse repo facility this entire time. And the net effect of that has been M2 going down. Money supply is the driver of inflation or deflation. Money supply increasing fast, prices increase fast. Money supply staying the same, there's no mechanism by which prices could continue to go up because there's not enough money continuing to chase those prices higher and higher. If the money supply drastically drops very quickly, you would see massive deflation very quickly. And despite the fact that you do have banks getting paid a nice paycheck and it's going up every time the Fed meets, that doesn't mean that it's going to translate into inflation just because bank reserves are getting more and more high quality inequality in terms of what they're getting paid. In fact, the more this happens, the more this sucks investment away from the private sector. This causes more income to be devoted to debt service costs. These are deflationary pressures. So when we come all the way full circle to the end result, the one thing that actually causes inflation or deflation, that's the money supply. And despite there being some inflationary pressures to raising rates, what the Fed is doing right now, it is not enough to offset the deflationary pressures that those same things are causing through different channels. Therefore, the effect on the M2 money supply has been to slightly decrease, and we are probably going to see an end to inflation within the next couple of months. It's one of my most controversial opinions, but I do think by January, February, March at the latest, we're going to see inflation at least 2%, probably lower. Because without more and more money, there is no mechanism by which prices can continue to go up. There's not enough money to be able to continue to push them higher and higher. So in summary, yes, while there are some inflationary pressures here from the way that the Federal Reserve tightens and raises rates and pays on reserves in the RRP, that doesn't mean it's enough to offset the deflationary pressures that it's doing from its other channels. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.